at some point, these companies, their ability to service that debt is going to diminish. We're headed right towards another big credit explosion, and I think what's happened in the oil market is what's going to trigger that.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit crushthestreet.com/gold.
Hello, everyone, and welcome into crushthestreet.com. We got another first-time guest today. We're going to be talking about the economy. His name is Dave Kranzler, and he has 30 years of experience in the financial markets. He's an expert. He's worked on Wall Street, and today he's a co-manager of a precious metals and mining stock investment fund in Denver. And today he publishes the Investment Research Dynamics blog, and his premium service is the Short Sellers Journal, and his website is investmentresearchdynamics.com. Dave, thanks so much for taking the time to join me today.
Thanks for having me on, Kenneth. I appreciate it.
Dave, I love talking to people who've worked on Wall Street and then come out and are able to come out and say, hey, things aren't the way they seem, and the way the media has been painting this rosy picture. And so I'm looking forward to our conversation. So let's go with your experience. You've actually traded bonds for a large bank. Now, the last time we saw junk bonds crash the way we are seeing now, we had the 2008 financial crisis. And the big crash in the high-yield bonds, we saw it really accelerate this last December 2015. And we're at those prices today still. Let's talk about the dynamics of what is happening in the junk bond market and what it's telling us about today's economy.
Well, that's a good question. The same excesses that built up the first time around that culminated in what they call the Great Financial Collapse in 2008. I mean, it was really a de facto collapse of the banking system that was bailed out at the last minute by the Federal Reserve and the taxpayers. But the same excesses and the same subprime-based lending that was going on, people, banks and private investors taking pools of money and recklessly lending it in the quest for chasing higher yields. And eventually, what happens is the people you lend that money to can't pay it back. And the same thing, it's just recycled, and it's happening over again in a slightly different form than it happened the first time around. I mean, the first time around it was largely driven by extremely fraudulent lending activity going on in the mortgage market. And that hasn't stopped. I mean, they've kind of reconstituted it and repackaged it. There's still a lot of reckless lending going on in the mortgage market, and some of it has shifted from the banks to these big private pools of capital. I mean, all the money that the Fed has printed has created just huge amounts of capital sloshing around the system, and there's nowhere to put it unless you want it to just sit in the bank and not earn anything. So wealthier people invest in these funds that invest in things like Silicon Valley unicorns, where we've seen a massive bubble in the private investment side of the technology world. So there's a huge private investment technology bubble that's gone on, and that's popping. And you've also seen big pools of capital now starting to be made available. That's a lot of that's what's funding this bubble in auto loans that's been created. And it's been, now there's, believe it or not, you can get the same types of mortgages that were available that led to that culminated with the 2008 financial system collapse, where you get 0% for the first 12 months or adjustable rate, but they're offered on the private side through private sources, and there's public companies now that are doing this.
Dave, is this sorry to interrupt you, is this what, because I've heard you talk about this, but is this what you refer to as hidden financial debt in the system?
That's a component of it, because there's also, again, it's caused a whole segment of new over-the-counter derivatives to blossom up. And the financial reforms that were supposed to curtail this and prevent it, the Dodd-Frank legislation and some of the other legislation that went through that was supposed to put brakes on Wall Street's ability to create these reckless lending vehicles. I mean, all Wall Street's done is just put a Band-Aid on the problem. All Wall Street has done is figured out another way around all the legislation. So the amount of derivatives outstanding now are just as great as they were in 2008. They've just used accounting gimmicks to make it look like it's not as great, but it really is.
Yeah, all that corporate buybacks, and Goldman Sachs even put out a piece that showed that corporate balance sheets are at highest leveraged in a decade, and corporate debt has doubled since 2008. Just like you're saying, we're back to where we were in 2008. The markets have been trying to deflate for the last however many years, and we just haven't allowed it to happen. So when it comes to corporations and companies, stocks, their ability to pay their debts is based on earnings. And we've seen these earnings roll over. And especially with the strengthening dollar around the world, the global earnings are shrinking for these companies. And what is this leading towards in the stock market with companies' earnings dropping and this leverage, this bubble in the economy that we're seeing? Where are we headed?
I'll tell you exactly where it's headed. At some point, see, you've had this massive explosion in credit, as you pointed out, and all companies have done is they've issued debt, and it's been bought up by pension funds and hedge funds who have all this cash, and they want something that's yielding higher than treasuries. So they go and they, okay, well, here's XYZ Corporation, and I can get a 2.5% coupon for a 5-year bond instead of a 1% coupon or a 0.75% coupon that I would get if I had to put that money into treasuries. So they buy that debt, and then the company turns around and buys back stock, or they make really bad investments. and at some point, these companies, their ability to service that debt is going to diminish, and it's going to cause we're headed right towards another big credit explosion. And I think what's happened in the oil market is what's going to trigger that. And the perfect poster child of what's going to happen to the stock market is what's happened to Kinder Morgan's stock. Mm. Kinder Morgan is just a completely over-leveraged behemoth, and people were sold on this story that it was it's got stable sources of income because it's got these take-or-pay contracts that it moves natural gas and oil and CO2 through its pipelines. Well, that's not true, because I'm working on a full-blown research report on Kinder Morgan, and I've come across some facts about Kinder Morgan that'll probably blow a lot of people away.
Oh, wow.
And so, you've seen the price of Kinder Morgan stock has gone from 44 to 13. Well, that was never supposed to happen. No. Well, the thing of it is, they've used accounting, very highly misleading accounting. The whole buildup in their business has been acquisition based for the most part. And as it turns out, I've been digging into these numbers, and they're not nearly as steady or stable as investors have been led to believe. And what happened was they took on all this debt to make big acquisitions, and at the same time they wanted to continue paying out a high dividend rate, and at the same time part of their story is fueled on CapEx, so they have to keep spending CapEx, otherwise the market's going to say something's wrong here. Mm-hmm. So the tension between what they're spending on CapEx and what they're spending on dividends and what they're spending on debt service, it all conflated, and Kinder Morgan's operating income has been declining quite a bit, actually, and they had to chop their dividend, and they're going to have to chop CapEx, and at some point, I think they're going to run into some trouble with all this debt that they have on their balance sheet. And people poo-poo that, oh, it's stable cash flow. Well, it's really not. And I can prove that with the numbers that I've been digging up by really piling through their financials, which most analysts, if not all other analysts, never do. And so what's happened to Kinder Morgan stock, I think, is what's going to eventually happen to the entire stock market.
Yeah, it's like this Ponzi scheme illusion that these companies continue to try to mask the underlying fundamentals for what is going on. And that's why it's great to have someone like you on who's able to come on and say, hey, no, this is what the picture really looks like. Dave, so let's talk about oil. You brought it up. What are your thoughts on oil at the moment? I mean, Morgan Stanley said that we're going to $20 oil based on a strong dollar that they see here going forward. I mean, is it just the strong dollar, or is it a global economic halt that's going to send oil to $20?
Well, you just answered your own question with that latter statement there. I mean, oil is a function of supply and demand, like everything else, and to me, oil is really, everyone refers to Dr. Copper, and I'm so tired of that term Dr. Copper, I can't tell you. But copper is a very important economic barometer, but oil is even more important because oil is used in everything. I mean, copper is used in most things. Oil is used in everything. Oil is used to produce copper. So
right.
we heard all these excuses when oil fell from 110 to 50 back in 2014. We heard all these excuses about, oh, that's the Saudis trying to flood the market to run the shale operators out of business. No one really. It was basically designed to take the attention off the fact that the U.S. shale companies were fraudulently reporting their reserves, had been rapidly depleting their reserves, and were unprofitable if with oil going below 80. And that's exactly what's happened. And all these shale companies, exploration companies, etc., they're all loaded up on junk debt, and that stuff's going to hit the wall very shortly here. If not this year, then next year. But I think we're going to see the huge effects of it this year. But anyway, the reason the price of oil is declining is, maybe at the margin there might have been a little bit more supply put on the world with all this extra production that's sprouted up in the United States in the last few years. But it's a function of demand, and demand is falling off a cliff, and that's why the price of oil is declining. Because if the economies were as healthy as the Fed officials and Wall Street seem to be promoting, then the price of there would be demand to sop up any of this extra supply of oil, but there's not, and it's not just this country. It's a global phenomenon where the global economy is grinding to a halt. I mean, there's been so much debt issued that and all the growth over the last, call it, decade or 15 years has been fueled by the ability to take on more and more debt. And I think the ability to take on more and more debt has finally hit a wall. And it's a global phenomenon, and that's why the price of oil is crashing. And a whole sector of our economic system fed off of issuing junk debt to fuel the growth of the energy industry and shale oil exploration in this country. And that stuff's going to hit a wall. It already has hit a wall, basically.
Dave, when it comes to economic energy and wealth, Mike Maloney talks about it not really being created or destroyed, but just transferred. And we've talked about some economic extremes in terms of what's going on in the stock market. So what are your thoughts on where the shifts are going to be taking place?
Well, I don't know if I agree with that statement completely, because I think what he's talking about, if you wanted to call it economic energy or economic wealth, a lot of that wealth and energy is sort of faux wealth that's been created artificially through the issuance of debt.
Right.
All right, debt that's issued behaves like money until you have to pay it back. And what's going to happen is you're going to have a massive black hole into which a lot of that wealth that was artificially created by debt issuance is going to disappear. There's going to be, someone's going to have to pay for it. The first time around, the Fed printed money to pay for part of it because all these banks would have had to have written down their balance sheets by like 80, 90%. If the Fed didn't do anything and if the government didn't take, close to $1 trillion of taxpayer money and transfer it to the banks. And that's where that transfer occurred the first time around that he's talking about. It was printed money, and it was money transferred from the taxpayers to the banks in order to keep that wealth from imploding. Well, this time around, I don't think they're going to have the ability to take it from the taxpayers, because I think you'd have a revolution in this country, and I think they know it. So,
now, do you think the banks are going to retain that wealth? Are they gonna be in front of the next cycle? Because obviously they're to a large extent in control of a lot of what is going on. I mean, who's going to see the disappearing of all of that wealth? Who's going to go through that?
Well, it's hard to say because that's a great question. It's a very great question. If they just let everything unfold naturally, the banks would all go out of business. We'd have a financial system collapse. It would be extremely painful for a while. I don't know how long. And eventually, free markets allowed to operate, there'd be a lot of people out there who took the initiative and started rebuilding and restructuring. You'd have a natural restructuring process. But what they're talking about this time around, the term bail-in, which I know you're familiar with,
Mm-hmm.
That's what may happen, is that once again there may be a transfer of that wealth as everyone who has their money inside these banks, they'll do these bail-ins like we saw in Cyprus.
A bail-in, that's kind of like the next step the Fed could take, the government could take, that's beyond low interest rates, negative interest rates, and then QE. That's like, the next unfathomable thing that they can take to like keep this whole system together and keep it from busting at the seams. I've been trying to kind of foresee like what would be the next step that they are going to take to kind of keep everything together, because left on its own, it would implode. So you think bail-ins are what's next?
Well, it's a good question, and we can only sort of speculate or surmise how this is going to play out. I mean, no one knows for sure.
Right,
It could get really funky. But in a sense, and in this sense, Michael Maloney's right, that a lot of that wealth, or a lot of the wealth energy that he's talking about has been transferred. It's been sucked out of the system by the extremely wealthy people. I mean, we've had billionaires just minted by the dozens over the last 10 years or 5 years. The existing billionaires have become billionaires to a greater degree. So you've had this extreme upper crust of extremely wealthy people who have sucked a lot of this wealth out of the system. But like I said, a lot of this debt that's been issued, that's fueled this faux wealth, let's call it, it's going to be extinguished, and that's going to create sort of a, I'd refer to the Ludwig von Mises crack up boom, and that's probably because they're not going to be able to transfer enough wealth out of the population to plug the holes that are going to blow wide open when this thing really blows. They're going to transfer what they... It's not going to cover it all. So you're going to have just for lack of a better term, a crack-up boom, and you're going to have that Kondratiev winter that people talk about, where it's going to be extremely painful for everyone except for the very, very upper crust who have managed to suck a lot of this wealth out of the system, or, as Mike Maloney put it, have benefited from the transfer of this wealth energy.
Mm-hmm. Dave, you're a co-manager of a precious metals and mining stock investment fund in Denver, so I know you got a lot of insight on precious metals. I mean, I'm looking at silver right now is $13.76, I believe, and gold is $10.86. It's down. Gold's down $9 for the day. Silver is down 10 cents roughly. And what are your thoughts on precious metals at the moment? I mean, we're talking about extremes in the economy. We're talking about transfer of wealth. I know, we have our own opinions on exactly what that exactly means, but I mean, what would it take for the bubbles to burst in the financial sector, the financialized economy that we have, but and just maybe a small amount of that to shift into precious metals, and what would that look like?
Well, I mean, that's a good question. I mean, when you quote prices like you just quoted, you're basically quoting paper price of gold, because that's what's controlling the price right now. I mean, the gold's down $10 today, but that price hit didn't happen until 7:30 East Coast time.
Right.
Gold was basically flat overnight. In Asia, India, China, and the countries in the Eastern Hemisphere that are just literally hoovering up as much physical gold as they can buy, they continued buying, and they were paying a higher price. They're benefiting from this. That's another example of where this wealth transfer is taking place, because you've got all this physical gold and silver that's migrating to the east, the Eastern Hemisphere, and that transfer is being aided and abetted by the Western banks and central banks and governments who are using paper derivatives to artificially suppress the price of gold and silver. At some point, they're going to lose their ability to do it. I mean, look at what's happened. The way to look at what's happened with gold and silver is it's basically the U.S. government and Federal Reserve has put in a massive price control mechanism. Because for them, if they were to take those price control mechanisms off and the price of gold and silver were allowed to engage in unfettered price discovery, we'd see much, much higher prices for gold and silver, and it would undermine everything that the U.S. government has been telling us about the economy, et cetera. I mean, who really believes a 5% unemployment rate?
No.
Yeah, it's 5% if you don't include the near 100 million people who have left the labor force and never have any hope of finding jobs.
I mean, even Trump, a guy, in the spotlight of the mainstream media, is saying, hey, the 5% number isn't real. And they're talking about the participation rate. They're actually saying, and it actually is becoming conventional wisdom to not believe the 5% unemployment rate. I know you don't hear that from the president or the media very much, but you are hearing that from a lot more people, and I think Main Street hopefully will feel this. I mean, obviously the guy who has a job and the system's working for him, he may not see it as a big deal, but there's a lot of people out there suffering. Dave, I want to shift real quick over to China. China's all over the headlines, and talking about the global markets, the global economy. What are your thoughts on China? I mean, are they going to be the catalyst for this bubble burst here in 2016? We've seen the worst open of the stock markets, right now with the few market trading days of the year. Is this what we can expect going into 2016? Is China going to be the catalyst for this?
Well, this has kind of been a thorn in my side, because every time you see media reports about the U.S. stock market going down, everyone wants to blame it on China. And yes, China has its own problems, and yes, China's economy is slowing down. But I thought the mythology was that the U.S. is the world's engine of economic growth. Mm-hmm. So why is China? Why are problems here? Why are economic and financial problems that develop here? Why is that China's fault?
John Rubino, Dave, talks about the story of the week. The economic collapse story of the week that's kind of driving the markets, and I guess China, it has been the story of the week, if you will, for the economic collapse.
Well, here's my point about this, and that is what you've seen is, yeah, of course, China's economy is slowing down, but think about, and it's slowing down over there domestically. There's no question about it. And I have a theory that part of what they're doing with this devaluation is they're trying to let the air out of its bubbles that have developed over there. But one of the engines of China's economic growth is their export business. And their two largest export markets are the EU and the United States. So if their exports slow down, it means that it's because imports from the United States and the EU have slowed down. Now, imports from the EU and the United States aren't slowing down because China's economy is getting weaker. They're slowing down because the economies over here are getting weaker, and especially the United States. I mean, we're a consumption-based economy. And you probably haven't seen it yet, but B of A put out a piece, and according to their credit card spending data, retail sales in November and December were a disaster. And that's because the consumer's slowing down. The consumer's got too much debt. It's taken on mortgage debt, or it has a monthly rent payment that's too high, plus it's taken on auto debt, or it has student loan debt. So there's too much debt in this economy, and if the consumer's 60, basically 2/3 of the economic activity in this country, and the consumer slows down, this economy is going to slow down dramatically, and that's what's happening, and that's why China's slow importing it. We're not importing much.
Well,
and China's fault. Is it China's fault that we're not importing as much? No, of course not.
well, I mean, China has, their balance sheet has exploded over the last 10 years. And I mean, they've built out their infrastructure.
So is the U.S. balance sheet. The amount of treasury debt outstanding in the U.S. has gone from 10 trillion when Obama took office to 18 trillion.
So
That's an explosion.
I don't disagree with you at all on that. The only thing
Right.
that I was going to say about China, though, and again, I'm not cheerleader for the U.S., the only thing I can say about China, though, is that they've done so much infrastructure building that's beyond like anything that needs to be done. Like they've spent their future economic growth by building bridges to nowhere. I mean, where are the construction jobs going to be in China for the next 20 years? Let
me ask you this, though. Where are those same jobs going to be in this country? I can tell you, because I drive around all over Denver all the time, because this is one of the things that I look out for. I do a lot of work in the housing and real estate sector. Denver has fomented a massive overcapacity in apartment building, and rents are already falling in Denver. And I've been renting since '04, so I watch the rental market every week. Rents are, and it's the same thing that's happened in China has happened here. It's just not being publicized. Denver's not the only major city where there's all of a sudden going to be a glut of apartment buildings that have gone up. It's already happening in New York City. The vacancy rate in New York City is at its highest that it's been since 2008. I just saw that statistic the other day. High-end real estate prices all along the East Coast, especially in New York and D.C., have rolled over and they're falling.
So Dave, what is the supply going to look?
My point is that while the overbuilding here hasn't been as extreme as it has been in China, we've also gone through the same period of overbuilding.
Yeah.
I mean, now you're seeing auto manufacturers are stuffing dealers because they've overproduced cars and they have nowhere to go with them.
Yeah, no, I that's a lot of sense right there. And talking about real estate, I mean, the argument that I hear, I don't know the exact numbers on it, but the argument is that supply has shrunk because of what we went through in '08 and the halt that we saw in construction. So a lot of the realtors, a realtor, anytime you talk to a realtor, it's a great time to buy for one reason or another. But they'll say, hey, the supply is not there for the growth that we're seeing, so prices are going to continue to go up. But that's not what you're saying.
Well, the supply hasn't shrunk. I mean, home builders. Here's the thing. That's what the myth is in the media. But I've analyzed the home builders all the time, and I have some home builder reports available on my website. But if you go through and you look at the balance sheet of these home builders, their inventories are at record levels. Their inventories are as high as they were at the peak in 2005 and 2006, because that's when new home sales peaked. Their inventories are as high as they were back then, but their level of sales is 1/3 to 1/2 of what they were back then. And so, I mean, this idea that, first of all, the real estate inventory numbers are highly misleading. And there's no question, we went through a period of what some people call it an echo bubble in housing. I call it a dead cat bounce in housing. And to be sure, the proliferation of 0 to 3% down payment mortgages, etc., made financing a home available to more people, and that caused home sales to bounce up a bit. But that whole party and ship has sailed, and we're already starting to see existing home sales and new home sales start to roll over, and it's going to really roll over in 2016. It took a little bit longer than I thought it would, but then I didn't think that Fannie and Freddie would roll out 0% down payment mortgage options during 2015, which is what they did. And they're doing that because they're desperate to try, and they know what's going on, and they're trying to stimulate housing sales. And in terms of the inventory, well, a lot of people, in terms of existing homes, there's a whole base of population that owns homes that are stuck. They don't have enough money to move up, and so they have no reason to sell the home that they're living in. They'll stay there until they lose their job and can't afford their mortgage. Because a lot of these people, took out too much debt during the first bubble to buy the home they're living in. So they can't move up. So yeah, there's been sort of at the mid-level, there's been a bit of a shortage of supply in most major cities up until now. We're going to start seeing a lot. We're going to see that situation correct quickly, and I'm already seeing it in Denver at the mid-level. But the upper level, and I get emails from people all around the country telling me they're seeing the same thing in their cities. Starting about last spring or early summer, all of a sudden I started seeing all these high-end houses come on the market. And I was just waiting, and I'm like, who's going to buy these houses? And I was waiting for the rate of listings of high-end homes to slow down, and it hasn't slowed down. I mean, there's some neighborhoods in Denver where the average house is, say, $1. And most of the houses, not most, but a lot of the houses are in the low seven figures. I mean, you can drive through, and there's blocks where there's 1 to 2 homes per block on the market.
Right.
So you're gonna get an implosion in the housing market, and this time around it may start from the top. You're also seeing a lot of these buy-to-rent corporate organizations are starting to unload parts of their portfolio, and that's going to cause inventory to flood on the market at some point. So again, we had a sort of an echo bubble in housing, and it's going to start to unwind here pretty quickly.
Dave, I couldn't agree with you more. You bring up some amazing points, and it's very urgent for people. I mean, especially when we're talking about real estate, because the reality is people need a place to live. If, someone is graduating college right now and going to get married, they can't really sit around and time things with what the market is doing. I mean, you gotta act. You gotta do something. You gotta make a decision on what to do with your housing. It's not like just a regular investment. So, I mean, it's really important things to discuss. So, in conclusion here, Dave, could you just give us your final thoughts on, what people should be doing to protect themselves, and also in that, just tell them a little more about your websites and what you're offering.
Sure. I mean, I think first and foremost, I don't think people should be daunted by what's happened to gold and silver in the last 4 years. I mean, if you look at the rate of return of gold and silver starting from when the bull market began in 2001, gold's up over 400% and silver's up close to 400% during that time span. And that's through, those numbers would be basically through today. In other words, gold and silver as asset investments have outperformed every other asset class out there. and people lose track of that because we've become so conditioned to, oh, what did my portfolio do last quarter? And people, people worry about that. So we had the price of gold and silver ran up and it came back down, and everyone thinks it's a bear market. Well, it's not a bear market. It's a sleeping bull market that I think is going to start taking off again. And so I think the most important thing that people can do right now is to take whatever cash they have invested in mutual funds, stock and bond mutual funds, and move it into precious metals. And don't put it into GLD or SLV. Take your money out of those funds and go buy physical gold and silver. Just call one of the national coin dealers, because that's where you're going to get the best price. You don't have to worry about authenticity. And buy gold and silver and just hide it in your house. Just keep it. One of these days you'll be glad you did that. I think the second thing people can do is, if you're thinking about buying a house, put the decision off for 6 months and see if you're still all excited about buying a house. I can tell you for a fact right now that anyone who bought a house in Denver with anything less than a 10% down mortgage, if they bought that house in June, they're now underwater on their mortgage, based on what prices have been doing in Denver. And I'm not saying that the prices are down 10%, but on a case-by-case basis, when you look at the all-in cost of buying and selling a home, if you had to turn around and sell your house that you bought in June and you used a 10% down or less mortgage, you're not going to get that mortgage fully paid off if you have to sell that house right now.
Yep.
So I would advise people, there's nothing wrong with renting, and that's another whole aspect that I've seen. There's a ton of houses that are for rent now all around Denver. I was renting homes back in '08, and I don't never remember seeing this many for rent signs outside of homes. It's a lot less expensive to rent a home. I mean, yeah, it's not yours, but usually people who rent these homes out, they let you do what you want to the yard, and you can basically treat it like it's yours, and you don't have all the related ancillary expenses of home ownership. And beyond that, I would just say, if your money's in a 401k or an IRA and you can't take it out, if you can take it out, I would take it out and pay the penalties and plow it right back into gold and silver. I did that in 2006 when silver was at 6 and gold was at 600, and I paid my taxes and penalties on it, and I'm ahead of the game now, even with what's happened to gold and silver over the last 4 years. I pay what I had to pay to get my money out of the IRA. But if you can't take it out of a 401k or an IRA, into money market funds, get it out of the way of the market, because we're going to have a big credit problem here. It's going to affect bond prices, and it's going to really affect the stock market.
Well, that's very, very aggressive advice, but we're in unprecedented times, which we're going to need to take some serious measures. So, Dave, if you want to just share a little bit about Short Sellers Journal and what our audience will find if they visit you there.
Sure. And just to get back to Kinder Morgan, since you and I first were talking about it about 15 minutes ago, the stock price has dropped another 40 cents. It's down to $13.13.
Wow.
The Short Sellers Journal it was meant to be sort of an easier to read and more summarized version of the full-blown research reports that I put out, which tend to be longer and very detail-oriented, and I get into a lot of technical aspects of the accounting of these companies, although I do explain it and I lay it out. But it's a weekly, it goes out weekly, and the format is that I try to pick one long-term short sell idea, and then one what I call a quick hit idea, and the quick hit idea depends on what happened the previous week. So if we see a stock that popped up, and I think it popped up for no reason or a silly reason, I'll put it in there as a quick hit idea that's meant to just be a 1 week trade where you can either short the stock, or I'll suggest a put option play on it. My example last week was Weight Watchers, which had popped up the previous week during Christmas and New Year's because Oprah had tweeted out some stupid tweet and she owns 10% of Weight Watchers now. She was some sort of promotional tweet for Weight Watchers. Weight Watchers stock went it skyrocketed, and I put it in as my quick hit idea for last week, and then the stock itself dropped 34%, and the put option I recommended went up over 600%. Now that's part of that's luck. That's not going to happen every week, but that's an example of what I try to do. And if I don't have a quick hit idea, then I try to come up with 2 ideas per week. The newsletter is delivered to your inbox, usually, ideally by like early Sunday evening. Sometimes it gets to be late Sunday evening, but it's meant to let you take advantage of the idea if you want to early Monday morning when the market's open. So it's $20 a month, and it's a monthly basis, so you don't get locked in for long term. You can try it out, and if you don't like it, you can just email me and cancel it.
That's Dave. That's excellent. So everyone, check him out there. Thanks so much for taking the time to come on the show with me today. I really do appreciate it.
Thanks for having me, Kenneth. I'd be happy to do it again sometime.